the Share Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. The Share Investing Podcast is hosted by Nick McCullum and supported by Share Dividend, an investment newsletter provider aimed at helping people invest better through low-cost, long-term positions in individual securities. All opinions expressed by Nick and podcast guests are solely their own opinions and do not necessarily reflect the opinions of Share Dividend. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. For more information about Share Dividend and the research our firm provides, go to www.sharedividend.com/research. Today's conversation is with Greg Powell, the Deputy Chief Investment Officer at MillerHoward Investments. Greg joined MillerHoward after a distinguished 19-year career as a portfolio manager and director of research at AllianceBernstein. Greg has a PhD in economics from Northwestern University and today oversees MillerHoward's income equity portfolios. Our conversation is wide-ranging and discusses everything from Greg's history prior to MillerHoward, the firm's history as an investment management organization, and the characteristics that MillerHoward views as important when selecting individual securities. Please enjoy this conversation with Greg Powell from MillerHoward Investments.
All right, so I thought in conversations like this, it's always interesting to start at the beginning. So I thought a cool way to start this conversation would be to rewind back to the start of your career, which was at General Motors in non-investing roles, to my understanding. So I thought we could begin by talking about how that experience shaped your early career and what made you eventually make the transition to investment management.
Well, I think working for a large corporation like General Motors is very different than the roles I've had in the investment world. But I don't really view it as a non-investment experience. Essentially, what I started doing, I started my career there as a forecaster, and I forecasted the medium and heavy-duty truck markets, size of the industry. And ultimately, that was part of a decision. My forecast went into a much more complicated decision on whether GM should stay in the industry or divest, and they ended up divesting in the late 80s. And so everything I did there kind of went into investment decisions, but it was only one piece of a much larger decision, and it was not the same as sitting at a desk and buying or selling a stock, but it was very much an investment decision. My most prominent role there was it was running a department that ran the market research prior to large capital expenditures. So every big investment in North America went through the same process, and my department did market research right at the end of the process before the go, no-go decision was made. And that research, I hate to say, was actually very accurate, but unfortunately frequently ignored by management. And we all know how the movie played out. So, I think it was a very good experience. It left me very skeptical of corporate managements, but also it gave me a big appreciation for finding businesses that had a positive tailwind. Because frankly, no matter what GM management did in the late 80s and early 90s, they were dealt a very bad hand. And so I don't think it was really surprising that it ended up in bankruptcy, in the financial crisis. So that's really what I took from it. I thought it was a great experience. The best financial decision I ever made was to leave the auto industry and go into investment management. But it was very.
And after your time at General Motors, you moved to AllianceBernstein. Can you talk a little bit about what your role was there and how it differed from your role at General Motors?
Oh, well, the role was completely different. At General Motors, I was typically a manager of large departments. My last department was sending out more questionnaires than the U.S. Census. It was our fun factoid. Of course, the U.S. Census only goes out every 10 years, so it's a little bit of a faulty statistic, but it gives you an idea of the level of effort. At AllianceBernstein, I was essentially starting over and learning a new skill. I think I went up the learning curve pretty quickly because of my background, but it was still a completely new skill. I was recruited to be an analyst on a hedge fund they were launching there. AllianceBernstein it was actually Bernstein, this was before the merger, had the philosophy of just hiring the people they liked the best and then putting them into the jobs that were open. So I started out actually as a healthcare analyst on a hedge fund and was promoted up to being director of research, which was a portfolio manager position on that fund, and I worked on it for many, many years. It was long-short U.S. equities, typically around 130-30, so it was, fully exposed to the market. Later on, I was promoted to work on, or to run the large cap U.S. value team, and that ran, we had large cap value, we had dividend-oriented funds, and we also had long-short funds.
So that, after AllianceBernstein, you joined MillerHoward, and I thought we could start this section of the conversation by talking a bit about the firm's history. To my understanding, MillerHoward started as a research firm that wasn't necessarily focused on dividend stocks and didn't necessarily manage outside money. So can you explain a bit about the firm's history and what eventually led MillerHoward to focus on income-producing securities?
Okay. At the outset, like you said, it was essentially a sell-side research firm. It did institutional research on large cap stocks for institutional clients. Then in the late 80s, the firm worked on what is considered a landmark study on utilities as an asset class, and basically identified the value of investing in companies that have a stable business but generate dividends for shareholders. And essentially this led to the firm's fundamental philosophy, which is best described as high quality stocks plus high dividend yield plus growth of yield equals income and opportunity. And that was really the foundation of the dividend-focused strategies. So after the paper came out, there was demand for a fund managed by the firm. It started off as a utilities-only fund, and that fund has evolved into our current infrastructure strategy. In the late 90s, there was client demand for a fund that was broader than just utilities, but used the same philosophy. And that was really the genesis of the income equity product, which is by far our largest product now.
So this is a nice segue to actually talk about what MillerHoward does today. You guys manage investment accounts focused on generating income based on a three-prong philosophy that you referenced earlier. So I thought an interesting way to start the conversation would be to ask how you measure and quantify each aspect of the three-prong philosophy that you mentioned earlier.
Well, let's start with the easy one, is yield. We take the stocks that have enough liquidity for us to buy, which is a very large number, and put them into deciles, with the 10th decile being the highest yield. We really focus on deciles 7 through 9. We do own some stocks in decile 10, but we're wary of the highest yielders. Frequently, if the highest yielders have a problem, the market's telling you that it has a problem. So we try to focus on decile 7 through 9 in terms of yield. Growth of yield is a more interesting question. Essentially, you want a company that can grow earnings, grow cash flow. You want a company that doesn't pay out, doesn't have a very high payout ratio now, because then there's no room to grow. And then also you need to find companies that have a propensity to increase the dividend. Some management teams will tell you, flat out, we're not going to increase the dividend. Well, then we take them for their word. But other companies have both a history of paying out a dividend and also an inclination to raise the dividend. I guess the best setup is a company that has a stated dividend philosophy. For example, they might say, we're going to pay out between 40 and 50% of free cash flow as dividends. That's perfect for us, because then if we forecast that free cash flow will grow, then we're comfortable that we'll get a growth in dividend. Quality is actually, that's the third prong. Quality is actually the most nuanced of the three, because quality can mean different things in different sectors. I would say there's no single metric that works across sectors. For example, if you're looking at leverage in a cyclical industry or in an industry like technology that's subject to big swings, having no debt is probably the best way to go for a company. Where if it's let's say it's a REIT that owns commercial buildings, of course that's going to have some debt. Now, we don't want companies in any industry that are stretching the envelope, but we're willing to accept some debt in certain industries where it's just stable and it's the best capital structure for that company. We also like stable industries, and this again is much more art than science. But if you start with utilities being a stable industry, now currently we're a little concerned with valuation of utilities, but in terms of stability, they really check that box. What's that mean? It means that you don't have a competitor that can come in and ruin the party. You don't have to really worry about consumer demand fluctuating dramatically year to year. So when we go look for for companies in other sectors, we're really looking for that. You're rarely going to find something as stable as a utility, but on the other hand, you don't want to have something that's very risky in terms of either demand or competition. A lot of times I say that stability is best defined by what it's not. There are no existential threats to the business. There's no pending make-or-break legal cases. There's no large risk regarding a regulatory approval for a critical product. And there's no potential new competitor or technology that would completely change everything in the industry. So we're really trying to avoid those and find companies where it's more predictable.
Many of the characteristics you referenced with respect to quality are qualitative in nature, like stability and the lack of existential threats. Do you apply any quantitative screens to companies when you're looking for high-quality dividend stock?
Oh, sure. There are leverage ratios which everybody uses, and of course we would look at that. Something that might be more interesting for your listeners is that we do look at short interest, and if the short interest is rising for a stock, that can be a big red flag. We're looking for situations that are not controversial. In my career, my favorite stocks have been stocks where the market's kind of bored with them. I'm not picking the darling, but I'm not picking the most controversial stock either. You try to find stocks where people are kind of bored with the situation, so there's not rising short interest, but people are missing the opportunity, because obviously to have a good investment, to some extent, the rest of the market has to miss the opportunity.
Are there any examples of stocks in today's market that you would categorize as being this kind of boring, overlooked stock that's neither very expensive nor very cheap?
Yeah, I would say that KLA-Tencor is, and the whole semi-cap equipment sector is kind of boring, in the sense that in technology, people are really focused on the flashiest elements of tech, Netflix, Facebook, and so on. But to run all that, there is a demand for computer chips, also to run the Internet of Things and self-driving vehicles. All of those things are going to require a lot of computer chips, and what KLA-Tencor does is it's really in the background. It makes process control equipment that's sold to manufacturers of semiconductors. And they have a very large market share. They're not going to be displaced on that basis. When new chip designs come out, companies, and these are mainly household names, Samsung, Intel, and so on, will buy their equipment to iron out the kinks in their process and raise the yield in their manufacturing process. So KLA Tencor sells at a multiple well below the market. It is, its cash and debt are roughly equal. I think the cash might be a little bit ahead by now. And it generates great free cash flow. But it's kind of in the background. It's not something that you would hear about at a cocktail party. So that would be an example of a stock we like.
Yes, of course. You also mentioned earlier that, the idea that different business models align themselves well to different capital structures, with a commercial REIT being an example of a business that you'd expect to have some sort of debt. I wanted to pivot a bit and talk about REITs and other different business legal structures like REITs and MLPs, and ask about what role they play in the portfolio management strategy employed at MillerHoward.
Well, I would say that historically, REITs and MLPs were a much larger fraction of the portfolio than they are now. I think going back to yield versus growth of yield, just as a simple aside, I think it's important to understand that if you are a dividend investor and a stock pays a high yield, it might not need as much growth to be a good investment as a stock that pays a lower yield. And so our concern right now with REITs in particular is that they're really bond proxies. You're not going to get a lot of growth. So as over the last 8 years, let's say, as investors have waded into these stocks and bid up the prices and bid down the yields, they really aren't as attractive to us as they used to be. In addition, if interest rates rise, since they are bond proxies, bonds are going to become a tough competitor from an investment standpoint for them. And so that's another thing that could depress performance. Overall, we probably, I won't say always, but, we do own REITs now. We tried to own REITs that have some growth prospect. So we have REITs that are in we have Digital Realty, which is an example, which runs data centers or owns the buildings that house data centers. So that's something that could have actual growth to it, so that we're avoiding just being in a bond proxy. MLPs is a much more difficult discussion. Essentially, a lot of MLPs have these IDRs, which are distribution rights that the general partner has, and over time these have become more and more onerous and have taken more of the cash flow from the MLP and left less for dividend investors. So we have tried to avoid we can't do this in our MLP strategy because it'd be too limiting, but in our income equity strategy, we've really pivoted away from MLPs that have the IDRs. I would say, in addition, the other issue with MLPs is some of them have wanted to come back to the market again and again and again for equity raises for new projects. And that really doesn't fit what we're trying to achieve just in general with the strategy. We really want companies that generate good cash flow, can internally invest that cash flow to drive future growth, but also have some cash flow left for investors. And if you're constantly having to come back to the market for equity, you're really not that self-perpetuating machine that we're looking for.
How would you say that the due diligence and research process would be different for REITs and MLPs versus traditional common equity?
Well, for MLPs, clearly, you just have to understand any of these structures that really don't exist elsewhere in the market, where there are demands on their cash flow that are, that take priority over the equity holders. So that's an issue, and really understanding that. The other thing about MLPs that's difficult is that the disclosure is not very good. And in fact, on our website, there's a very good video done by my colleague John Cusick, which is an open letter to MLP management. And one of the points he makes is that disclosure has just been terrible. And the thing you really want to know as an investor in general, these are pipelines, okay? And they're pipelines with long-term contracts. What we really want to know is when the contracts are rolling off. When the pipeline starts and they're signing up people for 10 and 20 years, then you can be very comfortable that, okay, that's a long time in the future. When that rolls off, I won't worry about it. Now we have to worry about it because many of these pipelines are, they've been around for a while, and contracts are rolling off. And we've been very frustrated with the level of disclosure really across the board for the industry. And so trying to figure that out is very important, because once the contract rolls over, it's going to reprice, and then you may just not have what you thought you had. In terms of the non-MLPs and REITs, just regular stocks, a lot of the due diligence is around the issue of, can it grow? We're really not looking for situations that are just stagnant because we're not looking for bonds. We're looking for equities, meaning we really want something that can grow. And so, it just completely depends on the industry what that actually means, but that's what we're researching.
You mentioned digital realty as an example of a REIT with a big growth runway, and I wanted to stay on the topic of REITs and MLPs and ask you if you have any favorites in those two categories today.
Well, we own EPD as a MLP, and that would probably be our favorite. They don't have IDRs, and we're pretty comfortable that they're not going to return to the market to raise equity. And those are really the two big check boxes we have for MLPs. I'd like to answer your question on REITs, but we're really pretty shy of REITs right now, in general. We do own Lamar, which is billboards. We do own digital realty. But, REITs are problematic at the current yield levels with interest rates going up.
I wanted to pivot the conversation next and talk about ESG strategies. So at MillerHoward, you guys have been managing ESG strategies for more than 2 decades, far earlier than when they became popular among the investment management world. So I thought we could talk a bit about how you assess the ESG characteristics of individual companies and perhaps describe some successful shareholder resolutions that your firm has been involved in over the years.
Okay. Well, first, thank you for noticing that we've been in this for a long time. I think a lot of firms just are trying to get on the bandwagon fairly late, but this firm has been engaged in this for a long time. We view ESG as part of the overall risk control we provide investors. As long-term investors, we really prefer forward-looking companies that are gradually adjusting to challenges rather than ones that are going to be forced by society or legally to make very abrupt, expensive changes. So that's really in general, what we're looking for. In terms of the mechanics, if we get interested in a particular stock, we ask our ESG team to investigate the stock before we do any deep research on the portfolio management team. And we will not buy stocks rejected by our ESG team, full stop. Now, their evaluation, I think the most important word to use is holistic. It's not any one thing. It's really a whole portrait of the company. And they look at sustainability reports. They look at SEC filings. They look at news reports. Basically anything we can uncover on the company. Now, we do have a few exclusionary screens, for instance, tobacco. But most of our ESG work is focused on governance, environmental practices, and workplace policies. Disclosure is a very important focal point. Disclosure implies both acknowledgement of a problem and the measurement of that problem. And back to working for a big company, I can say that anybody who's worked for a big company knows that if you measure it, if you publicize it, in general, it gets better. Just as an aside, I don't know if you know the man, Paul O'Neill was CEO of Alcoa for many years. He later became Secretary of Treasury under George W. Bush. And he was famous for announcing a policy on safety, and everybody thought he was nuts. But they said, okay, we're going to measure it, and we're going to make our aluminum plants the safest they can be, and we're going to try to improve every single year. And they did, and actually a lot of financial performance went in line with that, because it's basically, if you're running a tight ship, lots of things are going to work. And that was a very good thing to measure, and it was, definitely in line with the ESG way of looking at the world. It was a social metric, but it had good financial effects as well. As an example of something that's happened to me while I've been working here is that I had a pharmaceutical company. I don't want to get into the name, but I found it interesting from a financial standpoint, and so I asked our ESG team to take a look, and they came back and told me, well, we've got to reject this idea because this company has a long history of unethically compensating doctors for prescribing their drugs. And it wasn't just one instance. They convinced me it was a long history, and so we passed on the portfolio management side, and then sure enough, a mini scandal ensued later on, and I just thought, okay, that convinced me that they were really adding value. You asked about shareholder advocacy. So what I just went through is the selection of stocks in the portfolio. Once a stock's in the portfolio, we try to advocate for ESG policies. I would say that the way that works is the most successful situations are just simply dialogues. So, for example, enterprise products, which is EPD, the MLP, they don't. Since it's an MLP, we can't do a shareholder resolution, but we contacted them nonetheless and asked them for greater disclosure on ESG topics. There was very little available on their website. We had a constructive dialogue, and the company responded by adding an environmental and safety section to their website. And disclosure is quite good. For instance, if you go to the website, you'll see that they have a safety metric that, for better or worse, they disclose every year, and that's really what we're looking for. They've made the commitment to do additional disclosures, including emissions comparisons. So, that would be that was a good outcome. Last year we did file 9 shareholder resolutions, and 6 were withdrawn due to a successful negotiation with companies, and that's really what we're after. Is when we do this, is trying to get companies to come around and move in this direction.
Now, do you guys employ ESG guidelines for each of your investment strategies, or do you guys have dedicated ESG management accounts that investors can choose to deploy their capital into?
Our strategies are denoted as ESG or not. So income equity is an ESG strategy.
Okay, that makes sense.
There's some other strategies that don't have that screen. In general, across the board, we don't have any strategies that would have tobacco stocks, for example. But some of them aren't designated as ESG strategies, so they don't have the full screen that we have.
I want to continue to talk about your portfolio construction strategy. Specifically with respect to domestic versus international stocks. So how does MillerHoward think about investing internationally? Do you own any international stocks, or is the firm purely domestic?
Well, first let me say that I think this distinction doesn't matter as much as it used to, that even buying U.S. stocks, you're getting a lot of exposure to both overseas demand, overseas production, and currency issues. But to answer your question very specifically, we can buy stocks that are either dual listed in New York or have ADRs that sell in New York. So we don't buy anything that is not listed in the U.S. But we will buy stocks that are, let's say, have an ADR in New York, But even if most of their volume is in their home market, we can still buy that stock.
Are there any particular international stocks that MillerHoward sees as attractive today?
Well, we own Total, we own Aegon, we own HSBC. Those are all opportunities where the yield was a little bit higher than what we could find in the U.S. for a similar name, and so we allocated some of the portfolio to them.
One of the subsectors that we get asked about a lot at Share Dividend is the Canadian banking sector. Do you guys have a view on the appeal of the Canadian banks right now?
We own TD. I would say that here's how I would answer that question. I think it's still attractive, but recently I think the U.S. banks are increasingly more attractive. Just more and that relates more to what's going on in the U.S. banking system as opposed to Canada. Canada's, it's a little bit more of a stable situation. I know there's concern about, the housing market and so on, but they look pretty good to us. The difference is in the U.S. banks just for years were forced to retain capital. And this just went on for years and years and years. And now, in the last couple of years, the banks have done very well in the stress test. The Fed has allowed very large capital returns, both dividends and share buybacks. And the yields are getting very interesting. So I think on a relative basis, the U.S. banks are becoming a better investment.
Continuing to talk about portfolio construction and due diligence, how does MillerHoward think about the valuation of individual securities when assessing investment opportunities? And I guess to be more specific, are there any particular valuation metrics that you rely on the most, or do you take a holistic approach when you price securities?
Well, it's holistic in that any single metric can get you in trouble. But if I had to pick one that is a very good metric for stocks other than banks and insurance companies, it would be free cash flow as a percent of market capitalization. So that's really telling you is how much cash flow the company's throwing off after capital spending. And that, I think, is a very good measure of what's going to be available to dividend investors. Now, there's a host of things that can go wrong. If capital spending is lower than it should be, if the company's not investing in their plants and their plants are going to deteriorate, that's not it. That's not what you want. But if I had to pick one metric, that would be it. On the banks and insurance companies, that is trickier because really what you want to do is assess the quality of the measurement of the assets and liabilities. It would be very nice to find opportunities where the companies are selling for less than the value of their less than book value. So, for instance, Aegon in our portfolio is selling for less than book value. So that's a very interesting opportunity. You have to convince yourself that the assets and liabilities have been measured reasonably well and that the company can grow in the future. I would say banks and insurance companies can be a little different. For banks, though, I also just think a simple price to earnings that's a very good metric for banks. Takes everything into account.
Does MillerHoward have any steps in the investment selection process to try to avoid value traps? The proverbial catching a falling knife?
Yes, we're very wary of companies that have negative momentum, and so momentum can be defined as just the stock price movement over a period of time, or it can be described as an assessment of the business getting worse. And so I'm going to take it as the more general description. If you have a company where things are getting worse, the stock price is going down, or revenue's going down, or margins are going down, those are big red flags, and I much rather wait until the controversy has subsided. Management started to turn the company around, let somebody else pick the bottom, and wade in later. So that would be, I would say there's always an exception. That's why I'm hesitant to make it black and white. But in general, we're not looking for companies that are, diving into the abyss.
And how does MillerHoward think about diversification in terms of how many positions you hold and how you size the positions within the portfolio?
Yeah, I'm not sure we have anything unique in that regard. We typically have roughly 40, 45 stocks in the portfolio, which, academic studies have shown that, you don't really need much more than that to be diversified. We do our research from the bottoms up, so we're not making sector calls, but we try to have a mix of sectors within the portfolio so we don't have everything riding on one sector doing well. We also are very aware of unintended bets. So as an example, let me use interest rates as an example. If you're an income equity investor, you have an implicit bet in most of your portfolio that interest rates are going to go down, because that's what would make a bond proxy do well in terms of valuation. So when we saw interest rates start to go up, we said, okay, well, we need some offsets. You're probably never going to get rid of that bias because that bias is just in the asset class. But you can find stocks, value stocks that pay a dividend that are helped by higher interest rates. And so the two categories that we've used are banks and life insurance companies. And both of them should do better with higher rates. And it's not really to make a call on rates going higher, it's just to take that risk, mitigate the risk that's inherent in our asset class.
Well, I mean, as I'm sure you know, utilities and other higher yielding stocks will probably decline slightly in value as interest rates rise. So that's a nice hedge against that risk. And the Federal Reserve has communicated they intend to raise rates a lot. So it sounds like definitely some wise forecasting on behalf of the firm. Are the last thing I want to talk about diversification, are the positions roughly equal weighted, or do you overweight based on conviction?
We have a slight overweight on conviction. The other thing that goes into it is liquidity. There's a few things you learn doing this for many years, and one is that to be very aware of how liquid stocks are. And because when you want to get out, they're not going to be as liquid as they are typically. And so that's the other thing that goes into the calculation.
So we've talked about the history of MillerHoward, what the firm does today, and I wanted to wrap up by just asking, what does the future hold for MillerHoward as an investment firm, and what are you guys currently excited about today?
Even though it's our flagship product, what we're most excited about is, in fact, income equity. We think there's really a demand for income by investors. We think we have a good product, a good history, and that's really what we're working on every day. In terms of the positions in the portfolio, I think I'm very excited that we have some real growth prospects in the portfolio, tech and financial stocks that really have the ability to grow much faster than some of the bond proxies that I think historically both our fund and other funds have focused on. So we have a large weight in technology. We have a large weight in financials. We think both have very good prospects for growing their dividend. And that's what makes us excited about the product.
Awesome. Well, I just wanted to wrap up by saying thanks for taking some time to be on the podcast. It was a pleasure speaking with you, and I know our audience is going to learn a lot from listening to the conversation. So thanks, Greg.
Okay. Thanks, Nick. Have a good day.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube where we publish videos under the name Sure Dividend. See you next time.